Welcome all. Thanks for joining us tonight. So I'll kick things off now. We got Social Security planning. Tonight's speaker is Kevin Lynch Sr., my father, the one and only, owner of Westminster Wealth Management here in Hillsborough, New Jersey. He's a retirement and estate planning specialist. He assists his clients working towards protecting and preserving their wealth for themselves as well as future generations. Kevin is a registered representative with First Heartland Capital. That's our broker dealer. It's something we have to disclose, and has his Series 6, 63, and 65 licenses, as well as his life and health insurance licensing. He is board certified in the estate planning from the Institute of Business and Finance and has a certification in long-term care. We've been doing a long-term care presentation. It's actually gotten a lot of interest and positive feedback. We have one coming up on the 17th of this month if you're interested in joining us for that one. Kevin is the president of the Somerset County chapter for the Society of Financial Awareness. That's the acronym SOFA. You have probably heard us if you've joined our seminars before, use the word SOFA. SOFA is a not-for-profit educational speakers bureau. Their mission is to educate and inspire individuals and businesses to take action on financial matters. Through this organization, Kevin volunteers his time to present 4 to 6 times each month on an array of financial topics that are both free and beneficial to the attendees as well as to the organization. Kevin resides in Belmead with his wife, Terry, and 4 children, Kevin, Sean, Kate, and Mike. Kevin, take it away.
Thanks, Kev. I appreciate that. Hi, good evening, everybody. I don't know what it's doing around your parts, but it's been a very rainy, fall, chilly day today here in New Jersey. So that is the backdrop. We'll kick this off. The first slide that I like to chat about is this little brain teaser, and you'll understand as we go through it what it all means. But in life, would you rather be early or delayed? Would you rather pay a penalty or get a bonus? So that has a lot to do with Social Security, and we'll go through it, and I'll tell you kind of how that fits in. As Kevin mentioned, our broker dealer is First Heartland Capital. You see that's noted there. I just need to let you know that I am a licensed individual, and my compliance office is with First Heartland Capital. And then in addition to that, I do speak for SOFA, the Society for Financial Awareness, and they're a not-for-profit educational speakers bureau. We do absolutely no selling on these calls. The only thing we do is educate. And tonight's topic is Social Security. But you also heard Kevin say that we have other topics that we speak on. And I do have one coming up on long-term care planning later in the month. So if you do have interest in that, we certainly would welcome your attendance and join us there. Probably speak on, I'm going to say 12 to 14 different topics annually, and basically invite people to hear about those topics so that they can basically make better financial decisions for themselves. And that's really what our affiliation with SOFA is all about. Okay, so to get to the problem, and this is why I like to do this presentation. People are really hurting themselves and their retirements by making terrible, costly decisions about Social Security. You've been paying into this program your entire working life. You get to the end of the rainbow and you have an opportunity on how you want to take that check, and people fumble the ball. I see it again and again, and that's why I do this presentation. Things you need to know about Social Security. And by the way, this is no exhaustive list, but it's a great start. You have a lot of claiming options. If you don't know it, if you're a couple sitting on the call with me tonight, one couple could conceivably have up to 22,000 ways to claim their checks. You didn't mishear that. 22,000. Decisions have far-reaching consequences. I have folks that come in and they tell me we're turning on at 62 because that's the earliest age you can. And I ask a question of them, now, why are you going to do that? And the answer I get, and honestly, this is what people tell me, I wanted to get back some of that money that I put in all these years, and I'm not too sure the system is going to be around. I need to tell you all on the call tonight, if you're listening to me, please don't let that be your reason, i.e., we weren't sure the system was going to be around. The system will be around. Okay, it really will be. The choice definitely impacts both spouses. It really does. It is not a Ponzi scheme. Boy, I've heard that, and it's not bankrupt. We'll go through the finances of Social Security in a minute, but it is not bankrupt. Benefits, in fact, more than likely have already helped a family member. Might be your father, your mom, or brother, sister, sibling, and your friends are not experts. That's the other thing I found. I have very interesting perspectives that come into my office, and they usually start out like this. You know, my plumber has told me the best way that he has found to apply. Well, that's super, but I would not take your plumber's advice on how to claim Social Security. Let him fix your pipes. That's great. Let him fix your leaks. Don't take his advice, and really don't take your friend's advice unless they're an advisor who specializes in the field. Don't take their advice because everyone's situation is different. And even so, what was right for them may indeed not be right for you. So really do get advice on this. So here's what boomers want to know about Social Security. Well, number one, will it be there for me? Yeah, I mean, yes, it will. So just to allow people to focus on the conversation tonight, it will be there for you, okay? I have my doubts on whether it's going to be there for your grandkids. I really, and if your children are young enough, I don't know if it's going to be for them, there for them either. And I'll explain why as we go through. It has everything to do with demographics. How much can I expect to receive? That's another big issue, another big topic. And so I'm going to go through kind of how they calculate your benefit. And in that formula, you probably could take away kind of how you could see you could get more if you do certain things. And we'll talk about that. When should I apply? That is a big question many people have, and we'll go over that. How can I maximize my benefits? And will Social Security be enough to live on in retirement? Pretty much can tell you it won't be, but here's the important point. What percentage of your retirement income do you think Social Security comprises? You thought in the 1/3 range, you're right on. So it's between 35 and 40%. Now, why is that important to know? Well, because I want to make sure that you get as much as you possibly can out of the Social Security system. Why? Well, number one, you paid into it and you're entitled to it. Number two, Social Security is an inflation adjusted income. You can't say that for the pensions maybe that you get. You get a check and it stays that level for your entire life. Social Security doesn't work that way. In fact, Social Security in we're sitting here in November, this past January, folks got a 1.6% increase to their Social Security check. This coming January, they're going to get 1.3%. Now, listen, you might say, well, wow, that's not a lot. Well, let me tell you something, it's better than nothing. And that's really how you have to look at this because every bit helps. So let's see if we can understand the value of the program a little bit better. So will it be there for me? That was one of the first questions I asked. Well, let me tell you, the OASDI, now that's the original name for Social Security. It's the Old Age Survivors Disability Income Trust. It is still growing, okay? It is still growing. The trust balance as of 12/31 of 18, you see it, it's almost 2.9 trillion. And then you had the gazintas and the gazaltas for 2019. And then, so you see that the balance went up a little bit, just a tad, $3 billion for 2019. But what this doesn't display is that something very interestingly happened in the May timeframe last year in 2019. And what happened was the amount of cost going out of the program versus income coming in the program, cost was greater than income. So, the reason for that is demographics. We have a lot of people turning 65 who are eligible for Social Security. And indeed, that therein lies the concern from a long-term projection standpoint. And that concern is if we don't have some type of reform put to the system, well, by 2035, only 80%, or said another way, 80 cents on the dollar, it will be able to be paid out in benefits. So everyone will take a haircut in 2035. And interestingly, I just read from the actuary's table that the COVID craziness has actually impacted that 2035 date to be 2033 because of the amount of people on unemployment and what that virus has done to the economy. So if we don't do anything, okay, we don't do anything, then in 13 years, roughly, for 15 years, everyone who's on Social Security will have to take a haircut. Now, we have 13 to 15 years to do something about this. What are they thinking of doing? Well, here are some of the reform proposals that they're looking at. And you know as well as I that the sooner they take action on these things, the better. A cautionary point, I'll just tell you, has anyone heard anyone talking about Social Security reform lately? Plenty about the election, got that. No, they really haven't. And the reason for this is because it's not close enough to being a problem. You know, with the thinking is, oh, we got 13 years to worry about that. And to be honest with you, when they fixed the system during Reagan's administration, they didn't take action on that until about 6 weeks prior to checks being affected in a negative manner, meaning they would go down. So I'm not holding my breath that they're going to take any action in the next 6 months, but it is something and it is action that needs to be taken on this. So here are some of the things they're looking at. Okay, so the first one, increase maximum earnings subject to Social Security tax. So currently in 2020, if you make $137,700, okay, you pay the 6.2% that you pay into the FICA tax. So if you make more than that, though, you stop paying the 6.2%. So you essentially get a raise. So one of the things they're talking about is taking off that ceiling, okay, of what you'd be charged, you know, your Social Security FICA tax, and make it no ceiling. So no matter how much money you made, you would pay into the system. In 2021, by the way, the 137,700 is going up to, I think it's like 141. Every year that number goes up according to inflation. So here's another thing they're looking at, raise the normal retirement age. Now, I'll be honest with you, I think this one has legs because the way they fixed, and I'll put that in quotes because we're fixing it again, but the way they fixed it in the 80s during Reagan's administration is that's exactly what they did. They changed the full retirement age from age 66 to age 67 for those born after 1960. So they've already done this once. So I'm thinking they will probably do this again. I don't think anyone on the call here has to worry about it, but you know, pick a year of birth, 1990. Let's say you were born in 1990. Well, I fully think that you may have to wait till age 70 for full retirement age instead of age 67. So I think that's what's going to happen. Lower benefits for future retirees, certainly not very popular, okay, but it is something they're looking at. Reduce cost of living adjustments. Now, they already started to do this. So they were using a number of 2.6% as the cost of living adjustment. They already have that down, I think, to 2.3. They've already lowered that to 2.3. And honestly, when I run reports and I have Social Security as one of the aspects in my reporting in the software I use, I have Social Security going up 1.5% per year. That's kind of the number I use. I think it's much closer to what factually has been the case. So the bottom line for boomers, you know, is I really don't think your benefits are going to be affected by Social Security reform. This is boomers. I can't speak for your kids and your grandkids. And I'll tell you to that end, one of the things that I did for my kids is I actually got for each of them a permanent life insurance policy that I'm using and I'm overfunding it. So I'm building cash in it in addition to paying for the coverage. And what's going on there is that cash is making money to the tune of, you know, between 5 and 6% over the long haul. And essentially I'm using that as kind of the Social Security offset for my kids. because one thing, well, they have two things on their side. One, they have youth. So these life insurance policies they should qualify for. And number two, they have time. So the fact that they have time means that they have the benefit of compounding. And in most cases, that's 35 to 45 years, depending on the age of your child. And they'll be able to use the cash that accumulates in these policies as a tax-free benefit in retirement to supplement their retirement income. If Social Security is around, excellent. It's a cherry on top of the pie. But I'm thinking it's probably not going to be around, but I know the life insurance carrier will be around. So that's kind of what I'm doing for my own kids. And I've run it for my other family's kids, and it actually works quite well. It really does. So, but for boomers on the call, the bottom line is your Social Security is not going to be affected. So what's a clearer way to think about social? Well, I mentioned it. It's inflation protected income, excuse me. You paid the premium every paycheck. So let's be smart about how we pull the money out. It is really a tremendous benefit. And I really work hard to make sure people maximize that benefit for their retirement income. So Social Security, just to go over a couple of benefits here, offers income you can't outlive. So you can't run out of money with Social Security. So the idea of longevity risk, the risk of outliving your assets, can't happen. Social Security is going to be around for as long as you are. The other neat thing, and I'm still using a 2.6% inflation factor, the other neat thing is that Social Security offers annual inflation adjustments. So in 10 years, if your benefit was $2,000, well, in 10 years, at a 2.6% COLA, cost of living adjustment, well, that $2,000 is going to be $2,585. I think that just is a tremendous positive feature to Social Security. Obviously, the longer you wait to take your check, the bigger your check's going to be. And the bigger that check is, then the more the COLA is going to have an impact for you. I think it's just a great thing. So how much can I expect to receive from Social Security? Well, that's going to depend on two things. Okay, one, how much you earned over your working career, and two, the age at which you apply for benefits. Now, I just indicated the earliest age that you can apply for benefits is 62. Should you? Well, maybe, but let's just understand the pros and cons of doing so. Before I get to that, how is your benefit calculated? Now, you can go on to the Social Security website, by the way, and look at all this, but I just kind of narrowed it down to these 4 bullets. This is basically how everyone's Social Security benefit is calculated. At age 62, each year's earnings are tallied up and indexed for inflation. They then take the highest 35 years of earnings, and that's what's averaged. The highest 35. So now what happens if you don't have 35 years of numbers? Now, and how do you know that, by the way? Well, if you go to your Social Security statement, and that's the thing with the green bar on it that you usually get in the mail, but you can pull your own basically online. And you can do that at ssa.gov / my statement. And you can go and put in your username, password, you'd have to create it, and you can get your statement anytime. But the highest 35 years of what's used. Now, what if you took time out of the workforce to raise a family and you don't have 35 years of numbers? Your statement will indicate that. It's basically on page 3 where it has the year listed and then the amount of money you made that year. If you tally those up and you have 35 years of numbers, well, you basically have 35 years of actual numbers calculating towards your full retirement benefit. But here's the thing. If you don't have 35 years of numbers, and let's just say you have 30 years of numbers, what they do is they add 5 years of zeros into your average. And you all know what happens when zeros get averaged in, the average goes down. So some of the strategies here that I tell my families is that if you can work another year, 2, 3 years, and get any of those goose eggs changed to any number, you're going to have your full retirement benefit go up. And that is a real neat strategy that you can employ right now. Once they develop kind of what those 35 years are that you have, they then take that aim and they divide it by 3 bend points. Okay, it's a formula. And that's used to determine what's called your primary insurance amount, or your PIA. And that's the amount you're going to receive at your full retirement age. When is your full retirement age? Well, it depends on the year you're born. If you go back to the Social Security statement and you go to page 2, at the top, it has what your benefit is at age 62. And then the middle one, it has what your benefit is at your full retirement age. And in parentheses, they indicate what that is for you. For example, if you're born in 1957, your full retirement age is 66 and 6 months. If you were born in 1958, it's 66 and 8 months. 1960, if you're born in 1960, it's 67. So, but you can find it there, or you can, I have it coming up on the chart here as well. The benefit is increased most years by a cost of living adjustment. I just indicated that last year, well, excuse me, in 2020, January, 1.6%, that was the increase. They've already announced this coming January, 1.3% will be the increase. So it does go up. So if you look at an example, let's see, of a benefit formula, let's take a look at a boomer born in 1958, and maximum Social Security earnings every year since age 22. What do I mean by that? Well, he basically, or she, made the most that they could make in Social Security until they got to that point where the 6.2% was not removed anymore from their check. So I just said this year that was 137,000 and change. So every year they made the most. So back in 1984, you know, that high point was probably about $38,000. I think I remember the number right. It's about 38,000. So I would say in 1984, you made the 38,000, okay? The aim is then calculated to be 10,683. Where did I get that number? I got it from Social Security. They calculate an aim for everyone. If you wish to calculate this yourself, I know you can do that because on the website, socialsecurity.gov, on the website, they give you what the inflation factors are that they use each year. And on the benefit package, the benefit statement that you receive, you can see what your earnings are. If you take the one and you create a spreadsheet, you plug it into the other, it actually comes out right to what your aim is for your particular situation. The reason I know this is that because I have a client who's an actuary and he actually did it and told me that it does work. It comes right out to the right number. So just if you want to do it yourself, you know, go ahead, have at it, go right ahead. So the PIA formula, what they do is they take that first $960 from that 10,683 and they multiply it by a bend point of 0.9. It comes out with a factor. In this case, it's $864. Continuing on, they take the next 4,825 from that 10,683 aim. They multiply it by a bend point of 0.32, and the final amount of money, $48.98, by a bend point of 0.15. So if you add up the $960, the 4,825, and the 4,898, it adds up to the 10,683. Everyone's PIA is done the same way. What's different is what is your aim? And the aim is calculated according to your highest 35 years of earnings. So, and everyone's earnings are different. You may have more goose eggs in your highest 35 years than others. Okay. You then add up those numbers, you come up to 3142.70. What is that? Well, if you were a boomer born in 1958, that is the most you'd collect from Social Security per month, $3,142.70. That's what that means. So, you know, and some people might be sitting there and think, well, that's good to know, but why shouldn't I just claim early at 62 instead of delaying to full retirement age at 70? Well, here are some reasons why you might think about not doing that. Your monthly benefit is going to be reduced if you claim early. So you receive 100% of your PIA, PIA meaning primary insurance amount, if you wait to your full retirement age. If you don't wait to your full retirement age, you're considered claiming early and you won't get 100%. You'll get, For example, if you claim at 62, only 75% of your PIA. It may also be reduced for taxes and Medicare premiums. I'll show you that. And benefits could be withheld if you decide to work. So if you claim early and you want to work, your Social Security benefit could be impacted by something called the earnings test. Now, well, when should I apply? This is kind of the rubber meets the road. It isn't a simple decision for anybody. It's based on health status. So I can show you quite clearly on an Excel spreadsheet that you can collect at 62 or you can collect at 70. And the crossover point between when the age 70 check overcomes the age 62 check is about age 79. Okay, so if you have life expectancy where everybody in your family lives well into their 80s, you'd be best to collect at age 70. And so, but Kevin, I need income starting at age 65, 66. Well, that's where you can actually build an income bridge using some of the qualified dollars. Qualified dollars means IRA money, and you can start taking money from your IRAs or your 401ks sooner than age 72 when you have to. Well, that's a taxable event, Kevin. Why would I do that? I said, well, think about it. You know, you're not working anymore. So your marginal tax bracket is very low. So it might make a lot of sense to start taking from those tax deferred accounts because you're going to pay very little in tax. So there's a whole, strategy around that we can help with and help people figure that out. But, the other reason to consider taking Social Security is your need for income. If Social Security comprises really the income stream that you're going to rely on in retirement, then I certainly understand if you have to turn it on. I'm only here trying to explain what your other options are and why. So whether or not you plan to work, that goes into consideration. And your survivor needs, okay? That's a big one. That's a big one. And suffice it to say, survivor needs, what I tell my clients is that you normally have a husband and wife. Normally it's changing, but normally the husband has made more money, so their PIA is higher. Well, actuarially speaking, men pass away first. So the strategy there is that the male should wait as long as they possibly can to take that check, age 70, where they get delayed credits, so that when they pass away, who gets that bigger check? Well, their surviving wife, their surviving spouse. That's the idea. Will Social Security be enough to live on a retirement? Well, probably not, but you want to get as much from the system as you possibly can. And if it is 35 to 40% of your retirement income, that is a chunk. And you want to make sure you get everything that's due you. What is your full retirement age? Well, this is what the Reagan administration did. They revised it. So if you were born, for example, 1955, your full retirement age is now 66 and 2 months. So that kind of scale that's built there every 2 months, that's what they did in the Reagan administration. And I'll be honest, I would not be surprised to see this something similar get passed in fixing Social Security again, now that the system is going to be kind of short of change come 2035. So what if you apply for benefits early? Now, this is what I was mentioning before. This might discourage some folks from claiming early, because it is true you can claim at 62, but then you only get 75% of your benefit if your full retirement age is age 66. You don't get 100% until you wait till full retirement age, which in that case would be 66. So now here's the real interesting thing. Well, what if I apply after full retirement age? What if I hit age 66 and I'm like, you know what? I really don't need this income. My pension is enough, or I'm still working, or, host of reasons. Well, if you don't collect your Social Security check at full retirement age and you decide to wait, every year you wait, the government gives you a guaranteed 8% more. Let me say that again. They give you a guaranteed 8% more. I mean, how could I make you 8%? Well, you'd be taking on a lot of what? Risk in the market. This is guaranteed. So many times in many discussions, what I'll have is that please let your Social Security check continue to accrue and start. And if you do need income, take the income from that IRA CD that you're making 1% on. That's a much better strategy than pulling from Social Security that's giving you 8% delayed credits through age 70. Now, at age 70, turn it on because you don't get any more delayed credits after that point in time. So you definitely turn it on. So I also like to just let people know that you can go and get your Social Security benefit. Here it is right here, www.socialsecurity.gov/my statement. Please go make an account because this is a very critical revenue stream for you and your bride or you and your husband. And it's something that I would make sure that you know exactly what your benefits are. So again, why delayed benefits? Well, bigger checks to start. So look at age, 68. If we started, benefits without COLAs, benefits with COLAs, that's a $500 difference. If I look at the next chart and I say, people are living longer. Well, let's look at age, let's see, benefit 85. Well, if you're 85 today and you started your benefit at age 62, you'd be getting about 35, 37. But look at if you claimed at 70, it's 62, almost, $6,300. That is a huge amount of monthly income. That's a difference. And I would highly recommend, if you could, to delay that check so you take advantage of these delayed credits that are guaranteed by the government. So how can I maximize my benefits? Well, let's see if you can improve your earnings record. Take a look at it because I have seen mistakes. I'll tell you one that very recently I came across with somebody to the issue here, any missing years. I always ask people when they come in and meet, bring your Social Security statement. I just would like to see the numbers. So I'm looking at this one gentleman's statement and I'm reading it, 1980, 81, it all has earnings. So it's very easy to read. 80, 81, 82, 83. 84 wasn't there. It skipped over 85. And I said, oh, did you not work in 1984? And he said, what are you talking about? I says, well, you don't have an earning record. He never noticed this, by the way. So he took it out of my hand and he says, no, I worked at J&J for over 40 years. I said, I absolutely worked that year. He says, well, you're not being credited for it. And he goes, well, how do I fix that? And now that's the thing. It's up to the taxpayer to fix it. So luckily, being at J&J proved to his advantage, being there for so long. He went to the HR department. He was able to get his W-2 for that year, put on microfiche, put on J&J letterhead. He brought that into Social Security, and they were able to correct the record. But they do make mistakes, is my point. So you want to make sure that you're looking at your earnings record and make sure that for every year you worked, that you have there is a record of that number in there. Is very important. Apply for Social Security optimal time. So you really need to consider what your incomes are, what your income needs are, both now and in the future. What's your life expectancy? I talked about, if you have family members living into their 80s, at least the higher earner should wait till 70 to take that check. If on the flip side of that, by the way, everyone in your family is dead by, late 70s, then you might want to not wait till 70 to take the check. Maybe you might want to take it earlier. But you also want to consider your spouse's life expectancy. So if she has longevity and you do not, remember what I said about the men earning more, but actually speaking, they die first. So in that case, in order to leave more money to your spouse, I would wait to take the check. Incidentally, I have software that I run and I show people kind of the 4 or 5 scenarios, not 22,000. I don't show 22,000. I show 4 or 5 scenarios that, given their set of circumstances and their health, kind of how they might think about claiming to optimize the benefit. And I'd be happy to run that for folks on the call. So benefits are taxed, just be aware of that. So I mentioned this before, there is something called the earnings test, and understanding it is pretty important. And again, the earnings test only comes up if you decide to take your Social Security early. Okay, what does that mean? Well, that means you're taking the check prior to your full retirement age. What's my full retirement age? Depends on the year you were born, okay? So if you take at 62 and your full retirement age is 66 and 6 months, okay, and you decide to work, read that second bullet up there. $1 in benefits will be withheld for every $2 you earn over $18,240 in 2020. Kevin, that's a mouthful. What the heck does that mean? It means Social Security gives you a chit. They give you a chit of $18,240 that you can go make. You can go make that. If you're collecting Social Security and you make $18,240, you can keep your entire Social Security check. If you go over $18,240, $1 in Social Security benefits is going to be withheld for every $2 you make over $18,240. Okay, that's what that means. And I say in 2020 because that number is inflation adjusted. I actually, the number in 2021 is $19,147 or something. But I do know the numbers, and when I start presenting in 2021, I'll update them all. But that goes up every year. So the amount that you can make, that chit, as I call it, that goes up every year. But just be cognizant of the fact that they only give you that amount, and then if you make over that, they're going to start withdrawing your decreasing your benefit. Now, the benefit will be adjusted at full retirement age. Okay, it's like changing the oil in flight here. And what do I mean by that? Well, basically, look at it this way. If you collect Social Security at 62 and you have an earnings check at age 62, what are the chances if you make, just say in your earnings, let's just say you make $20,000, okay, a little over the 18,000. What are the chances that that 20,000 is going to be higher than one of your prior 35 years of work? Well, I don't know about you, but if you look at what you earned at age 20 and 21, which is probably going to be $7,000, that 20,000 is looking really good. So the chances are that 20,000 will replace one of those 35 earlier years because it's a higher number. Now, if that occurs, what happens to your Social Security check when it starts coming in the door to you at age 63? It's going to go up because you now have a higher earnings year at 62 being calculated into the 35 years. So that's how the system works, okay? Don't let the annual earnings test discourage you from working because, as I just described, in the long run, you're improving your Social Security income. If you want to avoid the earnings test totally, well, that's easily done. Wait for full retirement age before you take any Social Security, and then the earnings test doesn't apply, okay? In addition to the earnings test, you need to be aware that Social Security is taxed. Now, it is a very specific definition of income, and I have it at the bottom there. It's called provisional income, and provisional income is defined in a very specific manner. You know, TurboTax, all your tax software knows this. They calculate this for you. But provisional income is your adjusted gross income plus 1/2 of your Social Security benefit minus any tax-exempt interest. So if you go up to the chart and you pick married filing jointly, and I look at 32,000 to 44,000 of provisional income, up to 50% of your Social Security tax is subject, of your Social Security benefit is subject to taxation. I did not say it's a 50% tax. All I said is up to 50% of whatever you're getting in Social Security can be included in tax, which means 50% is not taxed, okay? So the highest that number could be is 85%, as you see on the chart, which means 15% of your Social Security would never be subject to tax in this formula here. This exists today. This is what goes on today. So let's talk about ways to minimize taxation of benefits. Well, reduce other income with tax-advantaged investments. Just can't use municipal bonds because you saw that that's in the definition of provisional income. Many people use annuities there. They grow on a tax-deferred basis. They're tax-advantaged for you. Anticipate, this is a big line here, anticipate IRA RMDs. So what's an RMD? Well, those are the required minimum distributions. They may put you in a higher tax bracket. And remember, they're required. So when you turn 72, you must start taking money on a distribution basis from your qualified accounts. And those accounts that are qualified are your IRAs, your 401ks, 403Bs, 457s, whatever you have, if it's a tax deferred vehicle, you have to start taking income from that at age 72. Well, I don't want to. I don't need income, you might say. Well, tough noogies. You have to take it because the government's waited long enough. The IRS has waited long enough for their income tax revenue. And that's why you have to take it. Now, you notice I said 72. Many of you may be thinking, hey, wasn't that 70 and a half? You're 100% right. They changed it this past December. It was 70 and a half that you had to take that RMD. Now it's age 72 that you have to take the required minimum distribution. Now, I'll caution you here because you want to anticipate taking these RMDs, because if you know you have to take the RMDs at 72 and you opt to wait to take your income from social at age 70, you could be in for a very rude awakening in that your marginal tax bracket throughout retirement might be higher than you otherwise thought it might be. Why? Well, because you're a very good saver. I have many clients who have significant dollars sitting in IRAs and tax deferred vehicles that they have to turn on the income at age 72. And if you waited to take your Social Security and got that 132% increase due to the delayed credits, again, you might be in for a rude awakening. So what do? Well, you want to start looking at this from a tax perspective much earlier than age 72. So when you're in your early 60s, you want to be strategizing with your tax advisor and your financial advisor on how best to take income. Remember, this taking of income is new. People have been accumulators for 40 years. Now you've got to take the money out. And there are strategies that you want to utilize to do so you don't pay more than you have to. One of those strategies is you could convert traditional IRAs to Roths. Now, what happens there? Well, Roths are super powerful, but the only issue is that when you do that conversion, that's a taxable event. So should you do a conversion? Well, really depends on, where do you see taxes headed in the future? Do you think taxes are going to be higher down the road or lower down the road? So do you want to pay taxes on the seed or you want to pay tax on the harvest? Well, the seed is much smaller. So you might want to pay tax now, be in a Roth, and let the Roth grow tax deferred for those dollars to come out tax free to you. Delay Social Security. It reduces the number of years benefits are even subject to tax. Reduce expenses, pay down debt, continue to manage taxes throughout retirement. Managing taxes in retirement, I am not a CPA. This is a team sport. I work with many CPAs in trying to advantage our clients to be the most tax effective we can make them. But you need to be looking at taxes and not just at age 65 or 72. You need to be looking to see how you can mitigate the tax consequence that is coming to you once you start pulling all this money out to live on in retirement. Again, the distribution phase is much different than the accumulation phase. Okay, the other thing I just would like to point out is that Medicare could shrink your check. So if you're receiving Social Security and you're over 65, if you're 65 and older, and you're old in Medicare, well, your Part B premium is going to be deducted directly from your Social Security check. So let's just look in 2020, the Part B premium is $144.60. By the way, I just saw a stat. I think the $144.60 in 2021 is going to up to $148.50. So it is going up. But let's just assume you have a $2,600 PIA, primary insurance amount, and your full retirement age is 67. So if you claimed your benefit at 62, well, the benefit is only 70% of the $2,600. So that's $1,820. And if you take the Part B premium out of that $1,820, it represents about 8% of your check. Pretty big chunk, I think. Whereas if you waited till 70, that would be, you'd get 124% of the 2,600. And if I were to take the $144.60 and divide it by the 3,224, well, that would only be 4%. So when you apply for social, what are the key points to remember? Well, Number one, if you apply early, your benefits start lower and they stay lower for life. I can't tell you, there's a big misconception on that first one, and that's why I bring it up. That people think, well, I'll just start my social, a little lower now. And when I turn 66, it'll pop up to doesn't pop up to anything. If you decide to start early, you're permanently actuarially reduced for the rest of your life. That you decided to start early, so now you get a lower benefit. COLAs will magnify that impact one way or the other. Your benefit may be taxed or reduced to cover your Medicare premiums. Please don't let the earnings test discourage you from working. Okay, I just described how it's kind of changing the oil in flight, and it basically catches up. Delaying benefits may give surviving spouse more income. So you might be sitting there saying, well, you know what, I'm not going to live all that long. So why shouldn't I just claim my benefit while I can? Well, I can tell you this, for couples, that could be disastrous. You should always minimize the higher earners benefit to protect the surviving, you should always maximize, as I've been saying, the higher earners benefit to protect that surviving spouse. And let's just look at a simple example. And I like to use examples because I think people kind of get it, instead of me just talking. So let's just look at a spousal benefit. And this is very typical how this works. So the spousal benefit, you get half the primary worker's PIA if started at full retirement age. Quick example, I have John whose PIA is 2,000. Jane she didn't work as much as John, but she took time out to raise the family. So her PIA is 800. Again, PIA stands for primary insurance amount, and that's the amount of money that you would receive at your full retirement age. So again, John's PIA is 2,000 and Jane's is 800. Well, if Jane applies for Social Security at her full retirement age, her benefit is going to be $1,000. Oh, but Kevin, she only earned 800. Doesn't matter. What she's entitled to, if she waits till full retirement age, is to get 50% of her husband's benefit. That increases the family's monthly income from $2,800 a month to $3,000 per month for forever, every month. So it's a big deal. That's how a typical spousal benefit works. Now, that's if Jane waits till full retirement age. Kevin, what if she goes ahead and instead of waiting until 66, assuming that 66 is her full retirement age, she goes and pulls the trigger and says, I'm collecting at 62. Well, she can, but then she doesn't get 50% because she didn't wait. She only gets 35% now of the benefit from her husband. So the easiest way to remember this is that no matter how you're applying, if you want the maximum there is to get in that scenario, you must wait till full retirement age to get that maximum. Otherwise, you're going to take a haircut. You're going to take less. So some of the rules around spousal benefits, primary worker must have filed for benefits. So for the woman to claim that 50%, the spouse had to have turned on his benefit. Spouse must be at least 62 for reduced benefit. Again, that reduction is like 35%. No delayed credits on spousal benefits after full retirement age. So coordinating spousal benefits, this is where many couples mess this up. This is really important to figure this out. And this is where I run reports and show people, here are the ways that I would recommend you file and the rationale for it. And again, that's where it's so critical that if we're trying to get the husband to wait because his benefit is higher, and we want those delayed credits, but we need income, well, then we've got to look and turn to the rest of the assets to see how can we build that income bridge to take advantage of those delayed credits so that they can really maximize what they're getting for their retirement income. That's really a fun activity. I really enjoy doing that with folks. Okay, so maximization strategy, number one. So here's something that's pretty straightforward. Where the lower earning spouse's PIA is more than 50% of the higher earning spouse's PIA, in order to get the most, you might both delay till 70. So if Bob's PIA is 2,000 and Mary's PIA is 1,800, 1,800 is more than 50%, okay? If they both wait till full retirement age, you'll get the maximum out of the system, okay? You could also have that lower, so that $1,800 person turn on early, okay? But that's where you start getting into the 22,000 scenarios that I mentioned earlier. And you can see how this can really change. This particular strategy maximizes the lifetime benefits over average or long life expectancies. Kind of a hybrid approach to that is that if you have a PIA where the spouse is 50% less than the other, the lower earning spouse could claim now, okay, and the higher earning spouse wait till 70. You know, that's a very typical scenario that I've run for clients, you know, especially if the lower earning spouse does not anticipate making more than the 18,240, then they could turn on and even, you know, get hit with the earnings test. But since they're not making more than the CHIT, they keep the whole check. So it's something that I've worked on with clients as well. There are, you know, again, there are customization analysis that I'll help folks with to run, and I'd be happy to, I've run them before, and I'd be happy to run them again for folks just to take a look at different scenarios for them. Well, and you might be sitting there saying, well, I'm already widowed. I don't know really if any of this applies to me. Is there any strategy for me? Well, I'll tell you, there is. If you're widowed or divorced, you may be eligible for what's called survivor benefits, divorced survivor benefits, or divorced spousal benefits that can increase your monthly check. And I've had situations come up where people did not realize that they were entitled to a benefit because they were divorced, you know, 10 years, but they were married for 15. So you are entitled to a benefit, you know, in certain situations. So two key factors with survivor benefits. One is, it's going to depend on I call these the two shoes falling, so to speak. So one, the first is the age at which the deceased spouse originally claimed his benefit. Now, he could claim early, or he could claim and wait and get delayed credits, okay? And then secondly, the other shoe is, so the surviving spouse, when did they decide to claim? So now, truth be told, in survivor benefits, the surviving spouse could claim the benefit as early as age 60. So if you ever hear someone say, well, I heard it was age 60 that you can claim a benefit. Well, if you're a survivor, that's true. If it's straight up Social Security benefits, it's age 62. The only time 60 comes into the equation is when you're referring to survivor benefits. That's it. Okay. So if the survivor claims before full retirement age, the surviving benefit is going to be a fraction of the original benefit, 71.5%. So if survivor claims at full retirement age or later, well, they're going to be entitled to 100% of the original benefit. If you want to just look at a quick example with me, let's just look at Joe and Julie are married, both are over full retirement age. Julie's benefit is $2,000. So in this case, she was the higher earner. Okay, it could be. It's really who's the higher earner. Joe's benefit is $1,200. Julie dies. Well, and what happens? Well, a couple of things. One, Joe notifies social, and his $1,200 benefit is replaced by a $2,000 survivor benefit. Now, it's not the average. He doesn't keep both checks. He basically will get the higher of the two checks. So, of course, you can see a couple of things going on here. So, and this was, from a planning perspective, this is what would concern me. So first off, it's pretty apparent they just lost $1,200 of income per month. Well, what are the other two things that are less apparent? What are the other two things that have just happened when you lose a spouse? Well, besides losing a spouse, I get that. So, well, one of them is your tax bracket just went up. Well, how is that? Well, you're now a single filer. You're not jointly filing anymore. And the third thing is that you just lost a tremendous exemption to over $12,000 in personal exemption, just lost when that person passed. So taxes go up and income has gone down. Not a good combination in this scenario. So a lot of the planning that I do is I'll look to see from a scenario planning perspective, what is the wife's situation if the husband passes first? And what is the husband's situation if the wife passes first? And you just have to know what that looks like. I know it's not a fun discussion. I understand, but you know, we're not going to be here forever. And you got to make sure that no matter what happens, either scenario, the person's okay. And that's the idea. So an example of delayed claiming, let's just take a look at this because this could be very, very big for the surviving spouse. We'll go back to this example, Joe and Julie. Her PIA is $2,000. And let's just say Julie came to this class and she said, geez, Kevin says I can get these delayed credits. So heck, I'm going to file for Social Security at 70. So her benefit is going to be 128% of the $2,000, or she's going to get 2560. And so then she dies. So Joe's benefit will be equal to Julie's benefit of 2560 if Joe claims his survivor benefit at 60. Now here's where some of the differentiators come in. If he claims at 60, he'll still get a benefit, but look at the haircut that he takes. He'll get 71.5% of the 2560. Now, where did I get 71.5? It's dictated. The Social Security Administration puts that together. That's the percentage that you receive, or 1,830. But if Joe claims his survivor benefit at his full retirement age, his benefit is going to be 100% of the 2560. So that's a $730 difference per month. That is a big number when you annualize that and you add then, 10 or 15 or 18 years to it. The rules around survivor benefits: a couple must be married at least 9 months at date of death. Survivor must be at least 60 for the reduced benefit. Survivor benefit is not available if widow remarries before age 60. So I had an interesting situation where I had a woman who lost her husband when they were both 56, and then she met somebody and they were 59, and she actually came to my class and realized this clause here that if you remarry before, and they wanted to marry, if survivor benefit is not available if the widow remarries before age 60. So they postponed their wedding for a year to get past her age 60 so that she wouldn't lose the benefit. So divorced spouse benefit lasts, at least 10 years. So the rules around divorced spouse benefits, say that 10 times fast. It's the same as spousal benefits if the marriage lasted 10 years. Now, they're very big on a 10-year time frame that your marriage had to last for you to be entitled to these benefits. And incidentally, I forgot to mention this. I meant to mention it before. Same-sex couple relationships, all entitled to the same benefits right here. So that was passed 4 or 5 years ago. So that's really good stuff. Person receiving divorced spouse benefit has to be unmarried. Okay, the ex-spouse is at least 62. And this is a big one, this number 4, and I don't want to lose track of this. Many people think, well, you know what, my ex is spiting me and not claiming his benefits, so now I can't get mine in a divorced spouse situation. Listen, this bullet here, if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits for you to get yours. If you don't know that, please know that now. And if you have family members that are in this situation, please spread the wealth. Make sure they know that, because they may be entitled to an income stream that they don't even know they're entitled to. I've had that happen. So the rules around divorced spouse benefits. So this is interesting. I like to call this my Johnny Carson chart, and you'll see why. Johnny was married to 3 or 4 different women for 10 years each. So here it is. More than one ex-spouse can receive benefits on the same worker's record. So Johnny has 4 spouses. Well, he did. They're not all living. 4 spouses collecting off his record. The benefits paid to one ex do not affect those paid to the worker. So Johnny's paycheck doesn't get affected from social. The current spouse, so his current wife, doesn't get affected, nor any of the other ex-spouses. They don't get affected either. Divorced spouse benefits stop upon remarriage of spouse collecting the benefits. So when you remarry, you're now tied to your new spouse, okay, your new husband or your new wife. So you're sitting there thinking, gee, this really is more complicated than I thought. Well, listen, this is why I started with this chart. In life, would you rather be early or delayed? Well, listen, with Social Security, if you delay your claiming, you get more. This is one time you don't want to collect early at 62. There may be situations that you have to. I went over some of those. But if you can wait and you can delay your benefit, you'll be gratified with additional monies later in retirement that actually grow bigger because the COLA is based on a larger number. Would you rather pay a penalty or get a bonus? Well, that's the 8% delayed credits. So, and again, what I see the problem is people are just making bad decisions in this realm. And you might, oh, it's just claiming Social Security. Listen, I have seen in my spreadsheets a $480,000 difference between people claiming at 62 and people claiming in an optimal fashion. $480,000 over their career, over their retirement. That's a lot of money. I would not like to see people on this call make that error. Key insights, just to summarize then of what we went over. Social Security offers inflation protected income that you can outlive, including benefits for your survivor. Your monthly benefit will reduce if you decide to claim early. Couples should always maximize the higher earner's benefit. And that could be the husband, that could be the wife. In most cases, it has been the husband, but it could be either. It's really the higher earner is the best way to look at it. If you're widowed or divorced, you may be eligible for benefits that can increase your check. You want to take Social Security, again, I represented, it's 35 to 40%. Where does the other 60% come from? It's right here. So you really need to kind of integrate that into any pensions you receive, IRAs and 401ks that you get, the RMDs that have to start at 72 with no choice, you must take that income, your investment portfolio, and whether or not you'd like to work. A quick word on the personnel at Social Security. They can estimate individual benefits, and they can also tell you the amount you're entitled to now. They don't know anything else about you, though. They don't know your longevity. They don't know your family history. They don't know your other assets. So they can't do any other planning for you. In fact, they're not allowed to. So just be aware of that. They can tell you what you can get now, but that's about it. So you have questions. I'd love to help folks with this. Some of the questions here. So when should I apply for Social Security? Well, I hope what you're coming away with is the answer to that is, it depends. It really depends on your situation and what your health is and what other assets you might have, whether you need to take the income or not, your longevity, your spouse's situation, your life expectancy. What if I want to keep working? Well, just be aware of that earnings test, which only applies if you decide to take Social Security early and you want to continue to work. If you don't take Social Security early and you work through full retirement age, and then you turn on social, well, then the earnings test doesn't apply. What if I've already applied? Oh, I didn't go over that. So what if you've already applied for Social Security and you want to do a do-over? Because you came to this class, you realized you turned on we're sitting here in November, you turned on your benefit this past summer, and you realized, oh, brother, you have a couple of months of income, we really don't need it. We probably should let it continue to accrue. Can you do a do-over? Well, yeah, you can. You actually, up to 12 months of when you started that first check, you can give all the money back, no interest, and you can start again as if you never started. So you can do a do-over. And it used to be that you could do a do-over anytime during Social Security. That's not the case anymore. Now they've limited it to 12 months. So, but yeah, so you can do a do-over and start again. How much will my benefit be? Well, depends how much you made over your working career and the age at which you wish to start benefits. How can I coordinate spousal benefits? Well, look to see who has made more. If you're both over that 50% of the higher earner, maybe you wait till 70 to take the check. And for income, maybe you start drawing upon IRAs and 401ks while you're in a very low tax bracket to do so. What's the best long-term strategy for my situation? I can't answer that here on the call. And that's why I invite people to meet if they'd like to. In fact, I offer folks a 15-minute, complimentary, I call it a confidence call, and we can just chat about your situation and what's going on. If you want to take that to another level and have a complimentary meeting, that's fine with me. What do I do next? Well, we're going to send out a questionnaire for folks, and I would ask if you'd fill it out. I'd be happy to give people kind of a 1 hour, complimentary meeting or a 15-minute phone call, whichever you'd like. Many people in the COVID time. I do have folks coming back into the office, but I also am very respectful of, people's desire, maybe just have a conference call. That's fine as well. So that's things that I do. If you've liked what you heard, if you like what you heard, could you please spread the word? We have a LinkedIn profile, Instagram, Facebook. If you could, like us and send it out there, maybe I could get more people coming on the call and hear, the information. We did record this particular session because we get a lot of requests about the information. So please let people know about it. Again, if you'd like to take me up on that 15-minute call, this is my email. This is my phone number. Our website is there. So if you'd like to do that, I'd be very, very pleased to do it. And with that said, do we have any folks that have questions with what we reviewed tonight? Let me just take time out. Maybe we can go and have some questions. All right, I see. That's funny. I see Uncle Mark and Aunt Ro. I just saw that. All right. So I hope everyone is well. And Gary, I see you're out there too. I just, if anyone has any questions, shoot them out. Otherwise, I just want to thank you so much for attending. I really do appreciate it.
I got a bad break. How you doing?
Good. Was that Gary?
Mark.
Oh, Mark, how are you, Mark? How's things?
Things are wonderful down here. It's raining here too.
It's got the whole coast, I think. I don't know. No, it's really damp up here, though. Yeah.
Yeah, so I had a question about this spousal benefit.